Hi there, I'm Chris Moflam. Welcome to African Findings Explained, a series of discussions designed to shine a light of clarity on research findings on topics relevant to ethical leadership for African development. In this episode, I'll discuss anti-money laundering. Imagine that you work for a small enterprise that exports or imports goods. For example, you export clothing from Kenya to the United States, or say you export blankets from Rwanda to the Democratic Republic of Congo. Your trade transactions may need to be facilitated by a bank. Access to finance for trade by small enterprises is an important driver of Africa's growth and development. A survey of trade finance in Africa published by the African Development Bank in September 2020 finds that regulatory challenges have emerged as a significant drag on trade finance in Africa. So, what's this about? It is the requirement that banks must dedicate time and resources to prevent and report money laundering. At the 1989 Paris Summit of the Group of Seven Industrialized Countries, the Financial Action Task Force on Money Laundering, or FATF, was established to develop anti-money laundering standards for the international community. In Africa, the FATF relies on a network of regional bodies to implement the standards. Money laundering is a greedy process of making illegally gained money, that is, dirty money, to appear legal or clean. The dirty money comes from criminal activities such as corruption, human trafficking, drug trafficking, and arms trafficking. Typically, money laundering involves three steps. First, a placement is done. That is, the dirty money is introduced into the financial system. For example, it is deposited into a bank account in multiple small amounts over a few days. Or the dirty money is used to buy monetary instruments which are then redeemed at another financial institution. Or the dirty money is smuggled across national borders. Second, the placement is followed by layering. The dirty money is moved around in multiple transactions to create confusion as a way to hide the origin of the money. For example, unusual wire transfer activities, unusual foreign currency exchanges or forex, activity inconsistent with a customer's business, and suspicious customer behavior. Finally, the money is integrated into the financial system through additional transactions until the dirty money appears clean and legitimate, such as using the money to invest in a business or buying real estate. If left unchecked, money laundering can destabilize African society through diminished foreign direct investment, unfriendly business environment, erosion of confidence in Africa's financial systems, and consequently, poor tax revenue needed to fund social services. That is why strict compliance with anti-money laundering standards is important. I am reminded of what the biblical Paul, an experienced apostle, writes to Timothy, a young leader in Ephesus, about being careful to avoid greed. I am also reminded of how the biblical Luke, a physician and evangelist, emphasizes Jesus' teaching on the moral of paying attention to greed, for one's life does not consist in the abundance of possessions. In conclusion, anti-money laundering rules are designed to prevent and fight greed. Given that banks are required to know their customers, they are also required to detect and report certain financial transactions and suspicious customer behaviors to anti-money laundering regulators for investigation. Thank you for listening. Please tune in to our next episode of African Findings Explained. I'll discuss how small businesses can capture more value for African consumers.